Booking Holdings is a company that provides travel and restaurant reservations online. It operates websites like Booking.com and Priceline.com, and investors are curious if this stock is a buy for 2026 and beyond. I'll answer that question in this video, looking at the company's revenue growth history and cash flow from operations. I'll evaluate its returns on invested capital and compare it with the cost of capital. I'll also reveal my fair value calculation using my proprietary DCF framework, and we'll look at valuation on a market multiples basis. We'll do all that in this short video. It'll be fast-paced, so let's get right into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company has demonstrated excellent revenue growth over the previous decade, and you should be asking, what's this big drop off here between 2019 and 2020? And if it's not obvious, I will highlight the reason, and it's because of the pandemic. If you remember, folks were encouraged to social distance, and traveling and leaving your home and going to restaurants or going in planes and hotels was highly discouraged, and people were not very interested in engaging in those activities. So the company's revenue absolutely collapsed, and it was similar for nearly every travel company. Excluding that blip, it's demonstrated excellent revenue that increased from $10.7 billion in 2016, more than doubling to $26 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 11%, even including this huge decrease between 2019 and 2020. Now, when I evaluate the company's returns on invested capital, we see another excellent trend here of improvement from 15.1% in 2016, more than tripling to over 48% in the most recent trailing 12-month period. It's an asset-light business model. Websites are not very expensive to operate, doesn't have a very large physical presence, doesn't own or operate any of the restaurants or hotels on the platform. It just brings folks to its website and earns fees every time there's something booked or purchased on its platform. An attractive business model to be sure, and returns on invested capital above 47-48% are extremely attractive. Similar metrics are demonstrated when I evaluate the company's cash flow from operations to sales. Again, we see this big dip here because of the pandemic, but excluding that, the company has maintained its operating cash flow to sales ratios of above 30%. A little bit concerning is that the company's cash flow from operations to sales has been trending downward. Even if you exclude the blip from the pandemic, it's fallen from 37% in 2016 to 33% in the most recent trailing 12-month period. And the company is highly exposed to the policies at Google, placing advertisements and search results, and latest changes to that policy could impact marketing costs for Booking.com. That's something to keep in mind. Additionally, as folks use large language models to help facilitate travel, that could be another change in the company's marketing expense. So those are two factors impacting bookings in the most recent few quarters and potentially over the next few quarters and beyond. So I mentioned some sticking points there, and those would be a major concern if bookings was trading at a premium valuation. But it's not. It's actually trading at a discount to the average stock in the S&P 500 while demonstrating double-digit growth, while demonstrating significant and improving returns on invested capital. So these valuations look attractive. The forward PE at 20 is less than the average stock in the S&P 500 by about 10 to 15%, and the forward price to OCF of 16 is also an attractive valuation metric to be sure. By the way, I'm getting all these charts from fiscal.ai. They help me aggregate a lot of financial information, saves me a bunch of time. If you're interested, there's a link in the description for their services, and you'll get a 15% discount for using my link to purchase their services. Now, when I go to valuation using my proprietary discounted cash flow model, I calculated an intrinsic value per share of $5,364. The current market price is $5,167. So applying a margin of safety, this stock looks fairly valued based on my proprietary DCF model. But this is the kind of business where I would feel okay buying it at a fair value. Sometimes there are some businesses where I think a fair value is too much to pay because of the embedded risks and because of the unattractiveness of the underlying business. That's not the case with bookings. The underlying business is very attractive, an asset-light business model, total addressable market that exceeds $2 trillion in annual spending when combined all the categories it operates. So it's an attractive business model in a very attractive industry. So a fair value would be great. But when looking at valuation comprehensively and including the market multiples, I would say the stock looks slightly undervalued. And so, to answer the question I posed in the headline, do I see bookings as an opportunity for 2026? The answer is yes. I have the stock rated as a buy, and I updated that on December 2nd. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.